As part of this video, we will be looking at how to build wealth using equity and index funds. I'm pausing for the disclaimer. Let's continue. As part of this contents, we will look at what is asset class, what is equity, what is index fund, what is my asset allocation for equity. We will look at what is my equity portfolio, and then we look at why borrowing works better. So asset class, as part of the earlier video where I was talking about the various financial tools I am using, I spoke about equity, debt and gold briefly there. So in this particular video, we will go in detail about equity, how I am managing that. To give a broad view, asset classes, investment specific ones are broadly categorized as equity, debt and gold. Equity is essentially a ownership in the company. For example, if you are buying an Infosys share, you are owning a piece of Infosys. Or if you are buying Nifty 50, it's an index fund where you have ownership in 50 companies also. And looking at the debt category, it's more like when you are lending to the institutions, it may be a bank or it may be a government or it may be a company. All this category falls into the debt category. If you look at gold, there are various options. Jewelry is the most famous one, but a lot of other alternate options available. And the main point of having different asset class is to manage the risk. If you look at the equity is like essentially you buy a small piece of the company. Company issues thousands or lakhs of shares. You go on one share into it, you will be in point some zeros and some one kind of a shareholding in that company, right? And these shares can be bought in stock exchanges. In India, we have this NSE and BSE. BSE is the older one and NSE is newer. And BSE is a Bombay Stock Exchange and NSE is a National Stock Exchange. And how this share values the share price of that particular stock, right? What is how the value is moving up and down. It doesn't change the actual value doesn't change instantaneously as we see in the tickers, right? The expectation change between the people who are buying and selling the stocks. People expect that things will go up for the company. Some people will go and expect that things will go down for the company. They want to exit the company. Someone will say, okay, this is a nice opportunity to get into that company and so on, right? Over time, as companies grow, your ownership grows in value via multiple steps. One, there can be a price appreciation over a period. You bought it for say 100 rupees and you sold it for the current price is like, let's say 1,000 rupees. That's the price itself has appreciated. And the other parts, what shares does is they issue dividends. Typically, based on what kind of share you are holding and treat their shareholders. Some company will issue more shares. They are more dividend focused. They will keep releasing dividends. Some will be more appreciating shares. They may not that much concentrate on dividends. And the other ways in which your ownership grows, one is like buybacks. When companies come back and say that, okay, we are cash rich and we want to take back our shares, reduce our number of shares that is around. By doing that, if you are continue to hold your share, the total share that is there for the company will shrink. So when that happens as well, the value will also go up. And similarly, over a period of time, stocks will be split or there will be some bonus stocks that will be issued and so on. So essentially, this stock has like multiple ways it is growing, and it's a long-term holding, right? So longer you hold, right, the company it grows over the time. So growth is never a straight line. So it goes up, stalls for a time, then goes up, or sometimes it comes down and then goes up. So we cannot predict that. It purely depends on the company, how they are managing things, how it is getting perceived outside, and so on. Let's look at an example, right? If you see here, this particular example, I have taken a graph of how the Infosys share price went over, let's say, 20 years. It started somewhere low in much lower, and it went up and up, and from $100 rupees or somewhere, it went 2,000 rupees, and if you see recently after I think post-COVID it has went up much higher, and then it stalled, it came down, went up, and so on. But if you don't look at this daily and let's say you invested 100 rupees 20 years back, And if you came back and saw what is the value of that, right? It has grown 12% every year. So the compounded annual growth rate here is like close to 12%. So the main challenge here is like when you go and pick the stocks, you need a lot of information. You need to follow a lot of things. You need to understand how the company operates. A lot of energy you have to put into understand how the particular stock will perform. A lot of speculation will be there. And if you have a day job and you where you cannot spend more time on all these things, don't spend time on them, right? So there is a way in which there is a systematic way in which we can go and buy about these things. Let's look at them. Index fund is a mutual fund that buys all the companies in an index automatically. There is no manual bias. There is no fund manager involved guessing which stock will win, which one has to be brought in, which one has to be sold out, and so on, right? It simply just tracks the index. It has low cost. There is no bias involved here. You just have to follow the index. Nifty 50 index fund will grow as same as or close to what the Nifty 50, the underlying 50 companies are growing, right? And this is a very low cost compared to other managed active funds. And it by itself it brings in the diversification. So earlier examples where we are looking at one stock where Infosys was going up and down over the long period of time. And here if we see, we are putting in 50 companies together. We are buying a bunch of companies. We are not buying one company at a time, right? We are buying all the 50 together using the index fund. So by doing a low cost fund and the fund by the nature of the index being diversified, it's a more of a smart investing decision we take. So if for example, if you see the index funds in NSE, the National Stock Exchange, right? So there are based on the market segments. There are 4 segments. I have listed it down here, which are like covering top 500 companies in that Indian stock market, right? So this specifically to NSE, this one. The Nifty 50 is the index which covers the first company to the 50th company by market capitalization. And next 50 covers 51 to 100. Similarly, Midcap 150 covers 101 to 250 company. And from 251 to 500 is where the small cap 250 comes. Essentially, we pick 500 top stocks in the NSE, and they are grouped into 4 different categories. There's a Nifty 50, Nifty Next 50, Mid Cap 150, and Small Cap 250. This broadly covers India's top 500 companies, right? So, and you can simply do a very basic approach where you can just say, okay, I will just buy Nifty 50, done with it, right? That also you can do, right? If you look at the index fund, specifically this Nifty 50, which has a CAGR of 14% and over past 20 years, buying a Nifty 50 instead of buying a single stock, right? So this is much better because the 50 companies, not all of them will go down, not all of them will go up together, right? Various economic cycle and various industry they operate in, the impact or changes that are happening like that can impact one of the company can also bring the index value down, but it may not be that much, right? Because it's 1 in 50, right? So essentially buying a bunch of companies rather than buying a one company at a time is a much better decision to take. So if you look about more index funds, what other index funds are there? The Nifty 50 is the top one where we have these top 50 companies in India, and there is a Sensex that is from BSE that is there where it is tracking top 30 Indian companies. Nasdaq 100 tracks top 100 non-financial tech-focused firms, whereas we go to S&P 500, it is again like whatever I was saying earlier, right? Similar to Nifty 500, it's tracking top 500 US company, broad market exposure. By combining India and US index funds, we get a more balanced diversification. So we have to look at adding some international index fund into our portfolio. And I have done a earlier video in a detailed way describing how I go and buy about a Nasdaq 100. If you are interested in Nasdaq 100, you can go and look at that video. Let's look at my equity allocation, right? So this is how I have put it up. This is my plan, right? This is not where I am. This is where I am wanting to be there. One is this Nifty 50 where I am putting 20%. So this is my equity allocation, right? So equity allocation is 80% of my overall portfolio. And Nifty 50 I am putting 20% to it, and Nifty Next 50 I am putting 10% to it, and mid cap another 10%, and small cap 250 as a 5% there. And Nasdaq is where I am so much bullish about, and I am putting close to 35% of it. and it covers broadly 500 companies in India and another 100 companies in US. So essentially, this is a balanced mix of stability, growth, and diversification entirely via index funds, right? So all five of them are index funds. What I am buying out. Given this equity allocation, the index funds I am buying, this is how my equity portfolio will look like, right? So it comprises of 600 companies, each contributed by the underlying index fund. If you look at these logos, most of these will be familiar to us in on some form or another. So if you look at Nasdaq 100, it has Nvidia, Apple, Microsoft, Google, Amazon, Broadcom, Meta, and Tesla. If you look at Nifty 50, it has Reliance, STFC, Airtel, TCS, ICICI Bank, SBI, Bajaj Finserv, and Infosys, and more, right? So essentially, the list goes on and on. So there are like 600 companies that I'm holding via by choosing these five index funds. A greater way to build wealth is the most boring way that is there. No research, nothing you have to do. You have to pick a mutual fund house, right? Find a way to go and buy these index funds. Be done with it, right? So simple as that. So boring as that, right? If you're lazy as well, you can also set up some SAPs which can automate this process. You don't have to really go and do anything on your own, right? Set it up for a year, then come back and review and rebalance if required and things like that. So you start building wealth by letting compounding work uninterrupted, right? Thank you for watching the video. If you find this useful, please like and share with your friends and subscribe for more videos. I'm Shakti Priyan. I'm sharing my experience on how I am building wealth. See you in the next video.